Okay, welcome back here for the second half of Chapter 11, and we're going to talk about the financial plan and the business plan. Ratio analysis is part of the financial plan and the business plan. Here we are looking at the relative importance of different assets compared to income and things like that. Ratio analysis is a way of expressing relationships between elements on financial statements, and it gives meaning to the numbers. So if I were to come to you and say that a small business has made a profit of $50,000 this year, how would you know if that's good or bad? Well, one way to know if that's good or bad is they made a profit of $50,000 on sales of $1 million, so that percentage would be 5%. That ratio, profit to revenue or sales, will be 5%, and that's not bad. But if I told you they had sales of $100 million and they only made $50,000, that would be a percentage of less than 1%. So that is not good. So ratio analysis gives meaning to the numbers that are generated from the financial statements. And we're going to look at 12 key ratios. The first types of ratios we're going to look at are liquidity ratios. This tells us whether a small business can pay its bills or not. Current ratio is the one most commonly referred to, and after that, quick ratio is very commonly referred to as well. So the current ratio, can we pay our bills? Can we pay our liabilities out of our current assets? So here you see an example on the slide is from Sam's Appliances from our textbook. And Sam's has a current ratio of 1.87, which is not bad. The rule of thumb for current ratio is 2 to 1 is good. So on this measure, 1.87 is fairly close. So that's not bad for a current ratio for Sam's Appliances. I think maybe a better measure of the firm's ability to pay its bills is the quick ratio. The quick ratio is quick assets divided by current liabilities. Quick assets are current assets less inventory. So you take out inventory from your current assets. And in this case, Sam's has quite a bit of inventory assets. And so it reduces his quick ratio to 0.63. 1 to 1 would be a good quick ratio. So Sam's is not very good on the quick ratio. Okay, leverage ratios measure the amount of financing that comes from our creditors. So we're looking at the debt that the company has. Debt is a powerful tool. It can either grow a company very rapidly and increase its ability to make money, or it can put you out of business. So we have to watch the debt ratios very carefully. There's three that we're concerned with: the debt ratio, debt to net worth, and times interest earned ratio. So debt ratio measures the percentage of total assets, the total debt divided by the total assets. So in this case, it's 0.68 for Sam's. So that's pretty high. That means that twice as much of the assets are provided for by borrowing as opposed to equity. So that's a high debt and a higher risk of default for the company. So the debt to net worth ratio, very similar. It compares what a business owes to what it is worth. Here we have 2.2 times debt compared to net worth. So this is a high ratio. The third ratio in this category is times interest earned. So to figure that, we take the earning before income and taxes. So net income minus interest, and taxes. And we divide that by the interest expense. So earnings before interest and taxes divided by total interest expense, in this case, equals 2.52, We want that ratio to at least be 2 to 1. More conservatively, we'd like that to be more like 4 to 1. So it's a little bit rough on Sam's here. So operating ratios look at how well we're managing the firm, how well we're managing the assets of the firm. So we look at inventory, we look at collections, we look at payables, and net sales to total assets. So those are the ratios that show how well the company is being managed. So the average inventory turnover ratio, the average number of times the firm's inventory is turned over during the accounting period. So here Sam's inventory is turned about 2 times per year, which is a bit slow. It takes 178 days for Sam's to sell his inventory. Of course, we're talking about average inventory, which is beginning plus ending divided by 2. The next ratio is the average collection period ratio. It tells us the number of days required to collect accounts receivable, so days outstanding. Here for Sam's, we have credit sales. This is not all sales, so this is only sales on credit. And that's divided by accounts receivable, the monies that customers owe to Sam's. And we see that the credit sales divided by accounts receivable is 7.31. And then we divide the 7.31 into 365. And we find that it takes about 50 days to collect the receivables owed to Sam's. So typical terms on collection in this instance would be 30 days, net 30. So this is slow because it's taking Sam's 50 days, and it should be taking more like 30 days to collect the accounts receivables. All right, average payable period ratio tells us the average number of days that we're taking to pay our bills. So very similar, we take our purchases divided by our accounts payable. And in this case for Sam's, that's 6.16 times a year. We divide the 365 by 6.61. So it's taking us about 59.3 days to pay our bills. Once again, this needs to be put in light of the terms from the creditors. If the terms are net 30, then Sam's is very slow. If the terms are net 60, then Sam's is okay on the payables. Okay, another ratio is the sales to total assets ratio. And here we find net sales 1.870 and total assets 847. So we're getting about 2 times a return on our sales, 2.21 on our assets. Finally, the last set of ratios is profitability ratios. And I mentioned this at the beginning of our talk about ratios, that we need to see the net profit in terms of another figure to see if the net profit is a good figure or not. So we can look at least 3 different ways to determine if the net profit is good for a company. And that is to sales, to assets, or to equity. The first figure that we look at is net profit on sales. Now for Sam's here, the net profit figure comes from the income statement, $60,000. The net sales also comes from the income statement, the top line, $1.8 million. So Sam's has a 3.24 net profit on sales. At least he's making a profit, that's good. But this seems like a bit of a low figure in relation to sales. You would want it to be higher. Then there again, you would compare this figure to an industry average, and I suspect the industry average will be more like 5 to 7% for Sam's. Okay, another way to look at net profit is in relation to total assets. So here the net profit 60,000 divided by the total assets 847,000, 7.15%, which seems a little better than compared to net sales. So if you were to take the assets and liquidate them, if you could, and convert that to cash, the $847,000 to cash, is 7% a decent return on those assets? Well, in today's economy, maybe so. It's not terrible. Now here we have the net profit to equity ratio, owner's equity. So that's net income, $60,000 divided by the owner's equity, $267,000. Once again, we have a positive figure. It's 22%. Now, this seems like a very high rate of return, and that is 22% is a high rate of return for owner's equity. But in a ratio, you have to figure both sides, and it may be that the owner's equity is low. In this case, with Sam's Appliances, the liabilities are high, the owner's equity is low. Therefore, it's giving you a better percentage than in reality you're actually getting. So this may not be the best figure to measure Sam's success. So ratios are ways to compare one company to another. The best comparison for a particular company is either a historical comparison, the current year versus past years, or the comparison of a company to other companies in its industry. And what we're looking for are deviations or red flags, things that tell us that there is a problem with a particular company. Critical numbers measure key financial and operational aspects of a company's performance. So in different industries, there are different things that are very important. Sales per labor hour in a supermarket is very important. Food costs in a restaurant. Load factor, number of passengers of seats filled on an airline are very important. So those critical numbers vary from industry to industry. So financial benchmarking is comparing our firm to other firms in the industry. So we're looking for any significant differences in our company's ratio compared to the industry average. Is the difference meaningful? Is the difference good or bad? What are the possible reasons for that difference? Remember, a ratio has two parts, the numerator and the denominator, and either one of those could be out of line, causing the ratio to look good or bad. Then, if there are problems, what action should I take to correct those problems? Another very significant analysis for small firms is the break-even point. This is the level of sales at which we're not making a profit or a loss, where we have zero profit, zero loss. That's the break-even point. It's very, very important for a small firm to reach the break-even point in sales, because once they get past the break-even point, they're going to start making a profit, and it can explode for a particular firm. So the break-even point is very, very important for startups and small businesses. So how can we calculate the break-even point? Well, step one, we determine the expenses that are going to be involved in our business. Step two, we categorize the expenses as either fixed or variable. Fixed expenses do not change with sales. Variable expenses change with sales. Variable expenses can be things like salesperson's commissions, cost of goods sold, advertising expense. Fixed expenses are things like the light bill, the water bill, the rent. It doesn't change depending on how many sales you make. So then we have to calculate the ratio of variable expenses to net sales, and we can compute the break-even point. The break-even point is the total fixed cost divided by the contribution margin, which is the variable and net sales. So here is a break-even analysis for an example company, in this case the Magic Shop. Net sales estimate $950,000, cost of goods sold $646, total expenses $236. You're dividing those expenses into variable and fixed. So the contribution margin is 0.26, and the break-even point is $682,000. Okay, so break-even calculation. So here's a chart of the break-even analysis for the magic shop. Once you reach that sales figure of 682 and go beyond that, you're going to make a profit on every sale. So in conclusion, the financial plan and the business plan is very, very important. The pro forma statements are probably the most important part of the financial plan and the business plan. We also include ratio analysis and break-even analysis as very important things for any small business. So this is a summary of the financial plan of the business plan.